Today, we are diving deep into the International Monetary Fund's latest global outlook. They've just dropped their big flagship reports, and honestly, they paint a really complex picture of where the world economy stands, and maybe more importantly, where it's headed. So let's get right into it.
And boom, right out of the gate, the IMF gives us the single most important idea in the whole report. This sentence is everything. On the surface, things look fine, right? Markets seem pretty chill. But the IMF is basically saying, don't be fooled. Just underneath that calm surface, the ground is shifting, and some serious risks are building up. So here's our game plan for unpacking all this. First, we'll tackle that idea of a calm before the storm. Then, we'll crunch the numbers. After that, we'll look at those cracks the IMF is so worried about, see what they're telling policymakers to do, and finally, we'll talk about what it all means for you. Okay, so first up, is this the calm before the storm? I mean, asset prices are up, volatility is low, so why is the IMF waving this big caution flag? Well, they're making a strong case that the global outlook is actually getting dimmer and that the happy mood in the markets might not be telling the whole story. And this is the thread that just runs through everything they've written. The main vibe here is vigilance. They see this fragile environment where economic growth is slowing down, but asset prices are sky high and debt is piling up. They're pretty much begging us not to get lulled into a false sense of security.
All right, let's get into the nitty-gritty. Let's talk numbers, because these are the core forecasts that are really forming the foundation for the IMF's whole cautious view for the next year.
So the headline number is that global growth is expected to slow down to 3.2% in 2025. And you might be asking, what's putting the brakes on things? Well, the IMF is pointing to some pretty big headwinds, like uncertainty around trade policy and all this talk about geoeconomic fragmentation, basically countries pulling apart, which they think is going to weigh on business investment. Now, if we zoom in on the US, the forecast is for growth to slow down a bit to 2%. The IMF calls this a cyclical cooling after a really strong period. But here's a fascinating twist. They also say that this slowdown is actually being cushioned by a huge surge in investment related to artificial intelligence. That's a pretty big deal. And what about inflation? Well, the global trend is still heading down, with a forecast of 4.2%. But, and this is a big but, the story is totally different depending on where you look. For example, in the US, they expect inflation to stay above that 2% target all the way until 2027, thanks in part to really strong consumer spending. And this table just lays that divergence out perfectly. I mean, look at this. You've got the US growing at a solid 2%, while the euro area is looking at a much slower recovery, just 1.2%. And then there's China, still growing fast at 4.8%, but it's dealing with a totally different problem, super low inflation because of ongoing issues in its property market.
Okay, so we've seen the headline numbers. Now, let's peel back the layers and look at what's really got the IMF concerned. This is where we get to the heart of their worries, the cracks they see forming right under that calm market surface.
So first on their watch list, stretched asset valuations, especially in US stocks. And they're not just saying, hey, prices are high. No, they're pointing to how concentrated the market has become. Basically, a tiny number of giant companies are having a massive influence on everything. And this chart just drives that point home. It's kind of wild, actually. The Magnificent 7 tech stocks now make up a full third of the S&P 500's value. The IMF makes a point of saying this is even more concentrated than at the peak of the dot-com bubble. That makes the entire market really, really sensitive to how just a handful of companies are doing. The second risk is a big one because it's in a place that's supposed to be super safe, government bonds. The IMF is warning that these core markets are on, and I'm quoting here, shakier footing. Why? Well, it's a mix of governments spending a lot of money and higher interest rates, which means it's getting more expensive for them to pay their debts. That makes them more vulnerable. And to put a number on this risk, and it's a jaw-dropping number, the IMF ran a stress test. They found that in a severely adverse scenario, you could see forced selling of US treasuries hit nearly $300 billion. A fire sale of that size could seriously mess with the market that, underpins the entire global financial system. Okay, the last two risks are pretty connected. On one hand, you've got all this trade tension, which is basically a constant drag on the economy. And on the other hand, you have the crazy growth of what they call the non-bank financial sector. You can think of it as the shadow banking world. The IMF is worried because this part of the system is less regulated. It's getting bigger and bigger, and it's hard to see what's going on inside. That makes it a perfect channel for financial stress to spread when you least expect it.
So, you've got slower growth and all these risks bubbling up. What's the game plan? What does the IMF think governments and central banks should actually do about it? Well, that brings us to their playbook. For governments, the advice is a clear three-step process. 1. Get your budgets in order and start rebuilding your rainy day funds. 2. While you're tightening the belt, make sure you're protecting the people who need it most. And 3, if you do need to spend more money, make sure that support is targeted, temporary, and totally transparent.
And for the central banks, the message is all about credibility and caution. They're saying stay flexible, follow the data, don't let politicians push you around, and whatever you do, be really, really careful about cutting interest rates until you are absolutely sure that inflation is dead and buried. All right, let's bring this all home. Last section. How does all this high-level analysis from the IMF connect back to the financial markets that we all watch every day?
This table does a fantastic job of connecting the dots. So you take a risk like extreme market concentration. What's the real-world implication? Well, it means there's a higher chance of a sharp drop in those big tech stocks. Or take that fragility in government debt. That could mean way more volatility in the bond market. And the risk from those non-bank lenders? The report warns it could lead to a credit crunch that spreads everywhere.
So when you put it all together, we circle right back to that main idea. There is a huge disconnect between the IMF's deep caution and the crazy optimism we're seeing in asset prices. They're pretty much arguing that markets are not taking this complex web of risks seriously enough.
And so the conclusion really has two clear messages. For policymakers, it's a wake-up call. Use this time while markets are calm to fix these underlying problems before they blow up. And for investors and everyone else, the message is to be aware of these fragilities and build some resilience. And that really leaves us with the big question, doesn't it? The IMF's findings present us with two competing stories. One story is of calm, optimistic markets. The other is a story of shifting, shaky ground. The billion-dollar question is, which one of these stories is going to be right?